This resilience and forward thinking are needed to succeed and thrive in the new world economy that is changing by the day and by the minute. And that was essentially the summary of the 93-page economic outlook report, which was released earlier today by Norrenberger, our licensed financial services supermarket. Joining me now for a drill down into this report is an investment market professional and the managing director of Norrenberger Asset Management, Pamina Yinkere. Great to have you with us tonight in the studios.
Thanks for having me.
Thank you. It's been quite some time.
Yes,
so this is a welcome. It's good to see you again, my friend.
Yes, it is.
Great. So give me what you call an overarching view of this report, of the global report in the first half. Let's have this helicopter view first.
Okay, so what the report pretty much looked at is to review what has happened in the first half of the year across the global economy, even in sub-Saharan Africa, and drills down to Nigeria and to the different markets and sectors. And if you look at the global economy, the key theme that is happening in and around there is central banks are beginning to change monetary policy stance across the European and Asian markets. However, the Fed still keeping an eye on the job numbers, still keeping an eye on inflation, and has not moved. I think that's the one central bank that has really not moved policy in line with the others. What we can see globally is that growth remains very, very fragile. So it's a key area to look at. But I think what really rocked the markets in H1 globally is trade tariffs. It really shook the market, turned things, in a different direction. Yeah. When Trump made those announcements in early April. But of course, what we've seen since that time is that they've made deals with a couple of countries, and it looks like things will not be as bad as previously thought. But I still think these are early days. We will still probably see impact of these tariffs further down in the second half of the year and maybe well into 2026. When you look at sub-Saharan Africa, what you find out is that we've seen improving macroeconomic situation across board.
That's what I was about to get into. That surprisingly, all reports begin to show that there was resilience despite this geopolitics, Trump, tariffs, tantrum, whatever it is, the war in Ukraine, Israel, Gaza, and all of that, China and the Taiwan area and all of that. So this resilience in the first half and inflation slowing down across a number of African economies. We've seen a few central banks cutting rates like Kenya, for example, and a few others. And a few are just holding on a little bit, trying to see how things are going. Where is all the, tell me a bit about that. Where is this resilience coming through for Africa? Are macroeconomics working? What's working?
I think it is pretty much post-COVID recovery. If you recall, after COVID, many governments had to do a lot of interventions to try and sustain their economies. The ripple effect of that didn't pan out too well. But what we are seeing now is that the huge inflation pain that many African countries witnessed in 2024 is abating. We are seeing even stability in currencies. I mean, if you look at the Ghanaian cedi, it's one of the best performing, probably the best performing currency in the world today.
That's I'm looking at that.
That has appreciated.
That's a very good solid green.
Yeah,
42.4%.
It's a solid green. If you look at our own Naira as well, has been pretty much stable, across this year. So the picture from a macro perspective across Africa has been
relatively green.
Yeah, it's been encouraging, I would say.
Encouraging.
Away from that, you're also seeing growth pick up in a couple of countries. Ghana is averaging over 5%. Kenya is tracking towards 5%. We've seen Nigeria's rebased GDP and what that looks like and what the future holds, for Nigeria's growth story. But I think the one weak spot has been South Africa. Growth has been very, very muted in South Africa for a whole number of reasons. You have energy crisis and all of that feeding through the South African economy. So, but broadly, I think the picture across sub-Saharan Africa has been positive.
So let's bring it home to Nigeria for me in January to June. Let's look at your dashboard on the economy. What do I see? You got quite a lot on that dashboard. Just want you to walk me through the first half in terms of the key parameters, and that's the economic scorecard for first half in that your report. 93-page. Do you guys ever have sleepless night putting that together? You must have a very great team.
Yeah.
Okay, so I see some green cans and red and black. So walk me through a bit of this very quickly.
Okay, there are a set of macro indicators that we track. And let me just cast our mind back to 2024. 2024, when we had our half-year report, about 90% of the indicators were red. If you're looking at anything from growth trajectory in GDP, inflation was rising, the currency was weakening, many of those indicators were red. But it's interesting to see that 1 year down the line, see the strong change,
quite
the flip that has pretty much happened.
Green shoots there.
You see more greens than you have red there. So this goes to tell the story about how Nigeria has fared in this first half of the year. And we think it's been one of, if you look at the title of our report, From Shock to Calm. I think this pretty much just summarizes what the Nigeria picture has been in the first half of the year.
Interesting. So if you look at these numbers and you say, look, sectors that should drive based on where we are, if you look at the current account, if you look at the PMI numbers in the first half and all of that, and you think that right now we can pick a few sectors to say, look, if I'm running into the second half, which you already step into already, this is how things should look like. We're almost one second month down in the second half already. Yes. Our time flies.
Yes, it is. It is. So when you look at, I think a key area to point out is what has happened with the rebasing of the GDP. We all know how important that needed to happen because the last time we had that kind of exercise was more than 10 years ago. And since then, the economy has changed totally. New sectors have come on board, sectors that we were probably not even looking at. You're looking at things like the digital economy, you're looking at things like the entertainment industry and how much that is contributing into growth and employment in the country. So it's pretty much just x-rays Nigeria today, right? And where you can begin to see where that growth is going to come from across board. So these new sectors sprouting out, there's a strong gig economy. The informal sector remains there, but I think it's taking a very different dynamics. What we are even seeing now is a bit more formalization of that informal sector because of the roles that the central bank's push for financial inclusion has led to. The likes of the fintech companies have pretty much democratized banking transactions. So a lot more is coming into the formal sector, and we are beginning to see that growth happen. Our banks are going through recapitalization now, so that itself is going to even be a key anchor for growth going forward. One of the areas which we will probably touch on later is how Nigeria is going to achieve its $1 trillion economy.
I saw that as a bit of a peg of that report, anchored around that. And I was looking at some of the sectors you outlined. I saw petroleum sector, I saw banking, I saw about 6 or 8 sectors that you and the rest of your team actually outlined as the sectors to watch out for in the second half of the year. Do you think these will be the key drivers for the economy?
Yeah, it will be the key drivers, but I think the central bank's push to get banks to recapitalize has been, I think it was one of foresight. Because if you're going to support that kind of economic growth, you need big banks, you need solid banks, you need banks that can do proper intermediation to drive that growth, right? And banks recapitalizing now just positions them to be able to meet that needs. But of course, there is a lot of opportunities in different sectors. We can even see, oil has been the mainstay, but away from oil, we can see that the non-oil economy is really, really, on a very strong drive across our country. Whether you're looking at agriculture or you're looking at the services industry, we are seeing very, very strong performance and output coming out of those spaces. So I think we like what we see so far. It was a lot of pain, casting our mind back to what we needed to do in 2003 and 2004, how our currency, faced a lot of challenges, and how subsidy removal, how that affected fuel prices. But a lot of pain, but we can see that the results are beginning to come on now. And I think another important thing which many people don't look at again is the tax laws that were recently passed by the president. What that does for us, it creates a platform with which Nigeria's government can increase revenue. It's going to be a strong growth lever, if you ask me, because of we've looked at it. There's another report that we did that we really zeroed in into the tax laws, and a section of this report also looks at it. So I think
You think we can drive, if you think we can pursue this $1 trillion economy from where we are right now? I saw your report, the kind of economic trajectory growth that we need to have. This is 2025. So 2030 is just around the corner. It's just 5 years, it's just 5 years here. You just put it together, and that's 2030. So do you think we can? Do you think we have that? Are we in that direction now? Do you think we can rally this all the way to 2030 for that $1 trillion?
It's possible, but it will take a lot of hard work. If you look at, by our estimates, we think that if we want to achieve a $1 trillion economy from where we are today, we need to grow the economy by 22%, nominal GDP by 22% year on year, to achieve that. And we probably need to have some stable to mild appreciation in the currency, such that, because anytime currency comes, it devastates our GDP. Translated into dollar. If you recall what happened, 2022, we are around $500 million. Billion dollars, sorry. And by 2024, we are just about 200 because of the currency impact. So we'll need to see some currency stability and appreciation, as well as very strong nominal GDP growth above 20% to be able to hit the $1 trillion mark in 2030.
So when you look at rebased GDP, inflation, and the central bank's Cardozo's cautious approach to interest rate cuts, put all of that together, I just mentioned the exchange rate, and all of this help you also have a sense of direction for the second half of the year.
Given the fact that we've seen a lot of improvement in many of the macroeconomic indices, we think going into the second half of the year, the scene is set for the central bank to begin to ease monetary policy. You've already seen the financial markets, the fixed income markets, and the money markets react to that. Interest rates have significantly come down from where they used to be. Our yield curve showed a very steep inversion. Now you're seeing more of a flattening in the yield curve. So this just goes to speak to the fact that the market is already anticipating that rate cut will come. A cut will come and we'll begin to ease monetary policy. We've been very tight in the last 18 to 24 months. An economy can only survive very high interest rates for a long time, for so much. At some point in time, you'll have to give, and you begin to think, hey, do we want to hold inflation and still worry about growth? That question comes through.
So when the central bank start cutting, do you think it's going to be sturdy? Maybe like Kenya, they've done about 7 consecutive. 25, 25, 50, 25.
I think it'll be more cautious in the sense that you don't want to shock the system, right?
Okay.
At the same time, we'll be looking at key data points, what's happening to inflation, how is inflation cooling off, Inflation is about 22%, thereabouts now, so you want to see how that pans out. You want to see how the rest of the economy is tracking along. You want to see how stable the currency becomes. And I think for me, that's one of the key successes of this year.
The currency is stable.
Against a lot, it has been stable.
Yes, it's been stable. But you talked about recovery as well, in which it gains more ground, as it were.
Yeah.
Against the US dollar. So how should all of this matter to investors? Lock in some gains. I'm sure you folks made a lot of money this year on the stock market, so that's why you're smiling all the way into the studios this evening. So the equity market has been really good.
Oh, that's
yes. So why should all of this? How would all of this matter? Those key sectors, then the key macroeconomics as well, and what you're seeing broadly across the economy, whether it is the Dangote refinery or what you're seeing in terms of non-oil sector improving strongly. You saw the numbers. The non-interest markets is also going up. You saw the cocoa is also, the data is also in your report. For the first time, we did about 1.2 trillion in the history of this country, with the cocoa prices also remaining very steady. So how do you think investors should play all of this down the remaining 4 or 5 months of the year?
If you look at the financial markets, the equities have done spectacularly well. In fact, before I got in here, I was just looking at, there is an equity model that we built in-house. It is doing twice the market.
The EMP.
It's doing twice the market performance. And I'm like, whoa, I wish I allocated a whole lot more to equities.
All your salaries in January.
Yeah. So
by now you wouldn't be here. You would be in the Bahamas or somewhere else.
Yeah. So the story for investors was clear. I remember in January I usually put out this short piece where I say where to invest for that year, and for this year my calls were go long fixed income because we'll probably not see interest rates like this for a long time. Okay. So lock in those high interest rates. Equities were still one of my top picks because I felt that our market remained undervalued. And I knew that if you begin to look at key sector-specific issues, for example, many of the big names, consumer names we had, suffered from currency losses last year. As we see a more stable currency this year, those losses are coming back. So I knew that would drive. So in our positioning, we leaned towards that. But for investors, I mean, interest rates are down now, so you need to start thinking of how to rebalance your portfolio. Equities have run very far, and you need to ask yourself how much more legs do equities have to go. So for us, we still think the market has some opportunities. At bonds at a 17-16% handle, I still think it's a decent level to get in for Nigeria. Because if you look at Nigeria's history, on average, our bond yields have oscillated between 12 and 14. That's a low end and a max. But to still be some 300 basis points above of that historic high, I think is a good level to come in. So I will still be playing the fixed income space. I would still play equities, but in a more cautious way. I'll be very selective. The market has really moved this year. So
the insurance boys are here. They're taking over the baton from their brother, the banks.
That's a whole new story. Yeah. And this is predicated on the new insurance law that the president just passed. So
that could have some wrong time down the line a little bit, because the regulator is saying, look, there could be recapitalization about 12 months from now. So
yes, it is needed. Just the way you're having big banks to support, you also need strong insurance companies to also play a role in the market. Okay. So I think investors can still make.
Well, sir, we're going to touch base with you a little bit later, but perhaps maybe as soon as we get towards the end of the third quarter, into the fourth quarter, to begin to take a look ahead and see when we've heard the next, when we have the next monetary policy, to see how things are going. It's good having you again here, my friend.
Yeah, it's great.
Thank you so much.
Thank you.
Enjoy your evening, and thank you for those drill down into the macroeconomic report. That's Pabina Yinkere, the Managing Director and CEO at Norrenberger Asset Management.